Buckle up, everyone. You are strapped in and ready for the Insurance Hour with me, your host, Carl Sussman, informing, educating, and entertaining Californians one policy at a time. This is Insurance Hour. Hello, hello. This is Insurance Hour, and I am your host, Carl Sussman. Thank you so much for being here today. We have a special guest with us today. As a matter of fact, we have R.J. Lemon. He is the editor-in-chief of ICLE, the International Center for Law and Economics. Now, let me fluff him up a little bit here. He joined the ICLE as editor-in-chief and senior fellow in November 2020. He's responsible for crafting and executing the editorial and communication strategy, managing its publication calendar, and contributing to research and the financial regulation and corporate governance program. He was previously director of finance, insurance, and trade policy for the R Street Institute, which he co-founded in June 2012. Earlier in his career, he was deputy director of Heartland's Institute Center on Finance, Insurance, and Real Estate, and public affairs director of the Independent Institute. As a journalist, he spent nearly a decade covering the insurance and financial services industry, first as a manager at AM Best Company's Washington Bureau, and later as a senior industry leader with SNL Financial. We have got a real brain with us. Thank you so much for being here, RJ.
Thanks for having me.
We have got a ton to talk about today. I want to let everyone know the phone lines are open. If they have questions they want to ask you, to please go ahead and reach out. Number's 559-656-0317. They can also send their questions in to questions@insurancehour.com. But let's jump right in because, again, we've got so much to cover. Before we jump into the actual meat and potatoes of it, tell me a little bit about your background.
Sure.
From yourself, in your own words, in the industry.
So, the main thing in the industry is I was with AM Best for a while and learned. I had gotten a producer's license just before. I was a journalist, primarily a journalist for my career. I was a newspaper guy. And then first I got a life and health license in New Jersey. Then I got a P&C license shortly after, just to do little stuff on the side. And then so happened, it was a time of great distress for newspapers. In the early 2000s, it has continued to be for the last 25 years. So moving into the trade journalism area seemed like a good idea at the time, and I knew a little bit about insurance. Went to work for AM Best, first up in Oldwick at HQ, and then I moved down to DC. I ran the DC bureau for about 6 years. Very exciting years, the years of Dodd-Frank, and the financial crisis, and Obamacare. So there was a lot going on. And then I was with SNL Financial, which is now part of S&P. Continued a little different audience. AM Best was mostly people in the industry. SNL Financial was mostly investors, investment banks, etc. A lot of people doing deals around the industry. So different audience. Got to learn different aspects, things that I didn't know as much about, like securitizations. And then in 2011, a source of mine, who was at the time at a think tank, libertarian conservative think tank called the Heartland Institute, was looking for someone to come work with him on his insurance and financial services project, which I did. And a few months after that, we decided to break off and start our own thing called the R Street Institute. And our first publication, and what continued to be a flagship publication, every year we did a 50-state ranking of insurance regulation. How the states regulate insurance, where they were successful, particularly in areas of solvency and consumer protection, and where they were less successful, particularly in areas like price controls and just needless red tape. And California, turns out, was always down there at the bottom of one of the worst states to try to do business in.
Interesting. Well,
Yep.
that leads us right to what we're probably going to focus on. There were two articles that you wrote. rethinking Prop 103's approach to insurance regulation and Prop 103, the intervener system. I guess the obvious question I was going to say is, what made you decide to write these? But it sounds like California has always been on your radar, putting it mildly. Yeah. So you want to give me a little bit of the genesis of what made you decide to really focus on California, and then I guess Prop 103.
So this people who are in the business probably know this, but California has long had an inflexible system, but it was possible to make money, right? It wasn't that in some states, Florida, where I live, if you were in the property insurance business for years, you could not make money. It was the tail risk was just too great. In California, especially in auto, it's a big state. You wanted to be in that state. And, it was a pain to do business there, but it was not like catastrophic to your bottom line. And as the wildfire problem got worse and worse, what were always annoying parts of California's system became, completely unworkable. You had in 2018 $20 billion in losses. Which the industry in the 30 years prior to that had made only $10 billion in profits. So you needed rate, and under the system, which would only it's inflexible to the extent that you cannot use any forward-looking projections. You can't use CAT models. You can't consider the cost of reinsurance. You could only use what were the average loss costs over the prior 20 years. Well, if the prior 20 years looks very different than what you expect the next 20 years to look like, you can't do business. So it really came to a head with several of the major carriers, State Farm, Allstate, Farmers, USAA, all basically coming forward and saying, we can't do this anymore. We're gonna pull out if you can't give us the rate that we need. And for years, the system created by Prop 103's ballot initiative in 1988 had sort of trudged along, and those who benefited from the system, these interveners, public advocacy groups that were paid essentially to bring complaints anytime a rate was filed and gum up the works and make it impossible to try to do business in a normal way as you would in any other state.
You know what? Do me a favor. Let's put a pin in that because I want to talk about that. We're going to take a quick break, and I want to jump into Prop 103, where it came from and where it is now. Special guest, R.J. Lehman. We'll be right back. Let's talk about earthquakes for a minute. Look, we know we live in earthquake country here in California. Powerful, devastating earthquakes have happened here before, and science says that they will happen again. They can't tell us exactly when. They can just tell us that it is going to happen. Count on it. Prepare for it. Did you know that earthquakes are not covered by your homeowner's insurance policy? You need a separate policy to give you the peace of mind that you will be able to recover without getting financially wiped out the next time we get hit with a big one. There is a great company here in California that will provide you with earthquake coverage you need at a price you can afford. That company is GeoVera. I have a policy through GeoVera. I really like how easy it is to choose from all of their great coverage options, backed by the financial strength that lets me know that they will be here for me when I need them the most. Go to getquake.com/insurance hour to learn more. That's getquake.com/insurance hour. Make sure you're ready for the day when the ground shakes again. Hello. This is Insurance Hour. I am your host, Carl Sussman. Thank you so much for being here today. We are back with our special guest, R.J. Lehman, and he is the editor-in-chief at ICLE, the International Center for Law and Economics. We are talking about Proposition 103 and California insurance markets in general. And before the break, we were going to just start talking about Proposition 103. So I'll let you just jump right in. It was passed back in '88. What was the market situation like back then, and what was Proposition 103 designed to do?
So in the 1980s, in many places, there were problems of rapidly escalating tort costs. There were juries that had found for the plaintiffs in many situations. In California, in particular, this manifested in some pretty amazing awards in first party damage losses, and the rates went up significantly. There was an effort to push back on that. Some stuff had already happened in terms of tort reform prior to 1988 that likely would have slowed the increase in insurance costs in the auto insurance space anyway. But in 1988, there were 6 ballot initiatives put on the ballot in California, all dealing with auto insurance. Prop 103 is the only one of those 6 that passed. It was written by a guy named Harvey Rosenfield, who's a longtime consumer advocate, former affiliate or associate of Ralph Nader, who had a group called at the time called the Foundation for Consumer and Taxpayer Rights, and it is now called Consumer Watchdog. It passed narrowly, about 51% of the vote, but it passed. It ordered rollbacks in rates. It created an elected insurance commissioner. It required that all property and casualty rates go through a prior approval process where that commissioner, you cannot use those rates until a commissioner approves them. It also created an intervener system, which meant individuals who had no connection to the insurance contract, they weren't parties, they were neither companies nor insureds, could come forward when a rate request was filed, or basically when any regulatory action was filed, and object. And if the department found that their objection contained valuable information, they would get paid by the state. That made filing rates much more difficult and a much slower process. Prop 103 also defined what you can use in rate making, and a lot of things that were excluded because they weren't listed as among the things that could be considered are common in other states, like using credit ratings or using the cost of reinsurance, using the cost forward-looking projections through catastrophe models, which didn't really exist much in 1988, so it wasn't in the text of the proposition, so therefore it was not considered something that you could use.
So it wasn't excluded, it just wasn't mentioned at all.
Wasn't mentioned at all, and so because it wasn't mentioned at all, it's not allowed. It's been the view of the department that it's not allowed. Right now, the department can change its mind, and we have some good evidence that recently the department has been changing its mind, but it took a crisis for us to get to that point. And the crisis is just there was no availability of property insurance in wildfire-prone areas in particular, but really across the whole state.
So you're talking about forward-looking modeling and reinsurance costs, and you're saying that for the most part has to do with property insurance.
Yeah.
But you're saying that Prop 103 was actually brought to the forefront because of an auto insurance rate situation that was happening. So how did we cross over from let's fix auto insurance rates from escalating to how we're going to regulate property insurance?
Auto insurance was clearly what was motivating Prop 103. But the text of Prop 103 does basically leave a whole swath of property and casualty lines beyond auto as possibly being considered, and that's the way the department has interpreted the rules over the years. There are things that were excluded that you would consider property insurance, but in California are not. So, for instance, workers' compensation until 2003, because workers' compensation was not regulated by the Department of Insurance. It was a whole separate Department of Labor. Until 2003, some stuff that Commissioner Garamendi fought for and so forth. There was no input whatsoever from the insurance department. It was just not even considered insurance, essentially.
Let's talk a little bit about the intervener process. So you're saying that someone that's not an insurance company, someone that's not even a policyholder, basically anybody, you or I, could decide that we're not happy with what an insurance company is looking to charge, and what can we do with that, and how has that sort of been hijacked as a process?
So you would first go forward. There's a process to apply to be a qualified intervener. You have to show that you have information, or you believe that you have information or a perspective that the department lacks. That's what's supposed to happen.
So the folks that in the Department of Insurance that get elected are being told that they don't have the right perspective. So I'm not trying to be glib.
That is the way it's theoretically supposed to work. Is that
I'm sorry. Go on.
I have some piece of information that the department does not have, and I'm going to bring it to the table. I make a pleading. The department has to look at my pleading and say, yes, this was valuable information from a qualified objector, intervener, and if that's the case and they incorporate it into their rate decision, usually a rate decision. I will keep saying rate decision, but technically it could be almost anything. Like if the department put out a new guideline, this has happened in the last year, new guidelines on what a complete application looks like, a complete rate application looks like, interveners could intervene in that case too. So
any type of communication between an insurance company and the regulatory body that somebody could basically step in and say, I don't like that.
Right. So in the normal course of, like say when a federal agency does something, and like this is something that my organization, ICLE, does all the time, they may have a request for comments. Like a new regulation is being promulgated, there'll be an open comment period. Different people will submit their comments on what they think the agency should do, but we don't get paid for that, right? That's the big difference. Is like
I want to talk more about what ICLE does and this concept of interveners for profit, which I guess is what you're saying that it's turned into. We'll take a quick break and we'll be right back with our special guest RJ Lehman. Stand by. We'll be right back with you.
Ladies and gentlemen, boys and girls, in just a few moments, the Window to the Magic podcast show will begin.
My name is Patrick.
My name is Calvin.
I'm Mouseketeer Gray.
My name is Paul, and I will be your guide through the wonderful world of Disney sound experiences.
This show is a weekly trip into the world of the Disney theme parks and resorts.
And this is the place where you get to use your ears to surround yourself with the magic.
For your safety, please remain seated while listening to the WindowToTheMagic.com podcast.
Maybe there's a name for this, something like Disnotic obsession. Please visit WindowToTheMagic.com for more information, or you can find us on Apple Podcasts and in the iHeartMedia app.
Hello. This is Insurance Hour. I am your host, Carl Sussman. Thank you so much for being here today. We are here with our special guest, RJ Lehman. He is the editor-in-chief at the International Center for Law and Economics. We've been having a great conversation. If you've missed any of it, make sure you go online and find the show so you can go back and listen to it. You can find us on iHeartMedia. You can find us on iTunes. You can find us on Apple Podcasts, of course, on YouTube. Just search for Insurance Hour. You'll find us somewhere. Right before the break, we were talking about Prop 103 and its effect on California's insurance market. And we were talking specifically about the intervener process and what it takes to be an intervener, what it is and what it's doing. So, RJ, I'll let you jump back in there.
Sure. So, the main thing that we would be concerned about with the intervener process is that the department has not historically exercised much judgment, in our opinion, as to who is bringing a good faith intervention or who is just sort of coasting for compensation, and we're talking millions of dollars in compensation over this period of time.
And who's paying for that?
It is generally the company who pays. There are some.
Wait, so an insurance company says they need to raise rates, let's just say, and a company can step in and object, and then they get paid for that?
They get paid most of the time out of the insurance company's pocket. Right.
Wow. Okay. Yeah. Well, that's not going to cut out anyone. Okay.
There are some circumstances in which the department may pay, but and that's usually involving an intervention that just is on a department matter, that there is no company per se involved. But most of the time it is a company most interventions are made on rate applications, and the company that is making the rate application ends up having to pay the intervener. So early on, there were a bunch of interveners, a bunch of organizations that participated in the intervener process. They kind of fell away by the early 2000s until there was really only one. That was Consumer Watchdog. There was like a 5-year period where Consumer Watchdog was the only intervener that ever received compensation. There's now like 4. The second is the Consumer Federation of California is sort of the number 2 intervener, and then there's 2 other smaller organizations that are rarely compensated, but sometimes. Consumer Watchdog gets about 85 to 90% of the compensation. And as you look at it, while they're supposed to make rate-specific interventions, that look at this, there's a specific application, and this is what the specific problem that we see with this application is. That's not really how it works. They've generally just they have boilerplate language that they file in every single rate case, and it's boilerplate language generally, and this is kind of funny, because it's supposed to be something that the department wouldn't come up with on its own. They are often arguments that the department has already rejected in other cases. But
so not only are they aware of it, but they've already made a determination on it.
Right. And they'll still get paid. And this is how it's worked for years and years, partly because Harvey Rosenfield has been, a very favored figure in the insurance regulation and consumer advocacy movement, and so he has been deferred to. Now,
you think the department's afraid of him?
They have been, definitely, because there have been occasions where either lawmakers or prior regulators have questioned Consumer Watchdog, and the response from Consumer Watchdog is to say that they are bought off, and that they're doing that currently with Commissioner Lara, Ricardo Lara, the current commissioner of California, who he and Governor Newsom have both recognized that California's insurance market is in a crisis. Things need to happen. That includes some regulatory changes in how the department interprets Prop 103 and how it applies Prop 103. And the Consumer Watchdog's response has been to accuse Commissioner Lara of just being in the industry's pocket. Which I can tell you is news to the industry, because that is.
I was going to say, I've been doing this for 30 years, and when carriers have an insurance commissioner that they like, we know about it, and when they have one they don't like, we know about it even more.
Sure.
And this is not their favorite commissioner by any stretch of the imagination.
Nor have most, right? They have not.
Right.
Like most commissioners, I'd say there were some periods going back a while now, but I've been around this industry long enough to remember when California sometimes elected Republicans, which is now going back several years. But when Commissioner Poizner was there, I'd say he was more friendly to the industry, and in the 90s,
Steve was more business oriented.
Business oriented, yes. He still certainly made many decisions the industry did not like, but he was considered a fair, a relatively fair intermediary. So anyway, last year, in the wake of this crisis, Governor Newsom sort of put out an executive order recognizing that there was a crisis and that they would take steps to try to encourage capital to come back to the market. Commissioner Lara has followed up with that and is in the process of, trying to push through a new project that would allow some of these things that as I mentioned earlier, the state is not historically seen as being allowed by Prop 103, including using reinsurance, using catastrophe models in certain circumstances. Basically, it's not across the board. It's just if you're a carrier and you agree to write policies in areas where there's a real capital problem, there's no availability, that they would allow it in those cases. Consumer Watchdog has not reacted well to those ideas. There's also been a few cases in the last year where the department has rejected Consumer Watchdog's intervener petitions. And
is that a new thing that we're seeing? Is that uncommon?
I would say very uncommon. And they did reject one petition from the Consumer Federation of California as well. Currently, the issue that's before us is that Consumer Watchdog has applied to renew its status as an intervener, and the department has not yet ruled on that. So right now, they are not an accredited intervener. That's been the case for about a month. And we expect.
Interesting. I want to talk a lot more about that, actually. And we'll take another quick break. But when we come back, I do want to talk about this concept of having to be an accredited consumer advocacy group, which I believe is every 2 years you have to prove to the department that you are that, right? And I want to talk about that right after the break. Again, our special guest, R.J. Lehman, thank you so much for all of this information so far. We've got a lot more coming right after this break. Sit back, relax, and we will be back in a flash.
Do you need homeowners insurance? Has your previous insurance company left the state, non-renewed your policy, or maybe they just raised your premium to an amount that you simply can't afford? Whatever the situation, we can help. Just dial pound 250 on your cell phone and say keyword insurance quote, and we will connect you with an agent who can assist you right away. Or if you prefer, you can visit us online at insurancehour.com/quotes. Whether you're looking for homeowners insurance or auto insurance, we'll send the best options straight to you. So, what are you waiting for? Simply dial pound 250 and say keyword insurance quote, and we will connect you with a live agent to help provide competitive quotes for your homeowners insurance or auto insurance. Don't get caught unprepared. Insure what matters with an insurance company you can trust and with a premium that you can afford. Don't put off until tomorrow what you should have done yesterday. Simply dial pound 250 on your cell phone and say keyword insurance quote.
Hello. This is Insurance Hour. I am your host, Carl Sussman. Thank you so much for being here today. Phone lines are open, 559-656-0317. You can also send an email to questions@insurancehour.com. If you want to get text updates, you can also send a text to 567-4CARL. That's 567-327-5275. And we will keep you up to date. Right now, we are talking with our special guest, R.J. Lehman, and we are talking about Proposition 103 in California and the intervener process. Before the break, we were talking about how you need to actually be a qualified consumer advocate in order to have the state and the insurance carriers pay you for your, your thoughts on some of these filings. Can you speak a little bit more about how that works and where we are with Consumer Watchdog that we were talking about?
Yeah, so early July, they have to, every 2 years have to be renewed. They have to file a petition to be a qualified intervener. Early July, their petition was set to expire. The commissioner let them know that he was not going to take an action by the expiration date, but he was reviewing their filing and it was requesting more comment from outside contributors, not getting paid, and that he'd have a decision no earlier than tomorrow, August 1st. So we expect tomorrow or in the days after, he will come up with something. It's hard to say what he'll ultimately rule, but the issues the questions at issue are, you need to file extensive documentation about your sources of revenue, your board of directors, and to prove that you actually do speak for consumers. And he indicated in response to their last filing that he was not convinced by what they had filed. So that is new. That is not something that's happened before.
For an organization that people seem to be afraid of, this definitely sounds like it could be a significant move from the department.
Yeah.
What would be the ramifications if it turns out that the insurance commissioner says, you know what, you're a for-profit money machine on these filings, you're no longer qualified? What would that actually mean to them, and what would that mean to, in essence, the market that we see right now?
I would imagine it would mean that they'll have to, submit a new filing, perhaps justify their what they are charging. I mean, there's some interesting questions. Like Harvey Rosenfeld himself doesn't actually have I think he's on the board of Consumer Watchdog, but he doesn't have a position at Consumer Watchdog as a paid employee. He is instead a contractor, and he's actually their largest contractor. So he had gotten about $6 million over the last 20 years, which is not a bad sum of money
for a consultant.
That's
a good gig.
That's a good gig. So there's that. They have an actuary firm that they use. It's based in New Jersey. The rules require that your contractors meet prevailing rates in LA or San Francisco. You get an interesting.
You're talking about rates. I want to make sure we're clear. We're talking about the rates they're charging, not premiums. We're talking about what the consumer groups are charging as their billing rates.
Their billing rates
Gotcha.
that companies would have to pay. Now, the first.
I'm still laughing. They have to explain why they're charging what per hour to fight the carriers that have to pay them.
Correct. Yes.
Okay.
And so you get an interesting question like, what is the prevailing rate if Consumer Watchdog is the only intervener, right? Is it just,
how do you average one? Is that the question?
How do you average one? Is it just whatever rate you charge is the prevailing rate? That becomes an interesting self-dealing. And also, are you actually comparing this New Jersey-based actuary to regulatory actuaries in San Francisco and LA would charge? Because it doesn't seem like we've gotten those comparisons. Or is it just that they can charge whatever, and since we're the only one using actuaries for these filings, again, we set the rate and then get to claim it. So those are some transparency questions, and I'm not saying necessarily that they're wrong, right? Like maybe that's all on the up and up. Maybe that is the prevailing rate, but it doesn't seem like it's ever been scrutinized. So it's a good question.
What do you think is Consumer Watchdog is always talking about how they are just the most pro-consumer, right? They're looking out for the average guy.
Yeah.
Since this is the law that is on the books for all these years, and we have the market conditions that we do today, how are they responding to basically look what's happened on your law and on your watch?
Yeah, they don't. They don't really. Or if they, to the extent that they do, it's just this is corporate greed is the cause of these problems, and not the fact that loss costs have gone up a lot, whether that's a result of climate change or settlement patterns. A lot of people are priced out of the city and they've moved into more rural areas. And if they develop those rural areas to be like the city, maybe you wouldn't get wildfires, right? But they're not. They are sparsely developed areas where wildfires are a real problem. So it's an interesting, insurance question. Floods are kind of the opposite, right? If you build in flood-prone areas, the more you build, the more loss you have. Wildfire is kind of like a bell curve. Like you start getting more losses as you get more people out there. But past a certain point, if you get enough development, you actually won't get wildfires because there's no trees. Right? Like that's
a little bittersweet, I suppose.
A little bittersweet, but you could make those decisions that like some of these areas areas that are wildfire prone, instead of having no one live in them, should have lots and lots of people live in them, because we do need housing as well. I mean, it's not just an insurance crisis in California, it's also a housing crisis.
Mm-hmm.
Yeah.
And how does California, if you can, I want to just get a little bit in before our next break.
Yeah.
How does California, I know you had said that they're they're at the bottom of the list. How do they compare really when it comes to the other states in the country with regard to regulations?
So these are the most extensive, but there are other states where there. So as an example, North Carolina is essentially the only state that still uses the old pre-1970s system where industry filings are made jointly. So there's one rate for an HO3, or there's one rate for single passenger, standard private passenger auto. And the only deviations from that rate are how much you charge for marketing, whether it's agent commission or whatever. So there's no competition.
Interesting. I want to talk a little bit more about the ramifications in California. Let's take another quick break. When we come back, let's talk about what the market looks like in California and hopefully where we're going to go to fix this. Be right back.
Ladies and gentlemen, boys and girls, in just a few moments, the Window to the Magic podcast show will begin.
My name is Patrick.
My name is Calvin.
I'm Mouseketeer Gray.
My name is Paul, and I will be your guide through the wonderful world of Disney sound experiences.
This show is a weekly trip into the world of the Disney theme parks and resorts.
And this is the place where you get to use your ears to surround yourself with the magic.
For your safety, please remain seated while listening to the WindowToTheMagic.com podcast.
Maybe there's a name for this, something like Disnotic obsession. Please visit WindowToTheMagic.com for more information, or you can find us on Apple Podcasts and in the iHeartMedia app.
Hello. This is Insurance Hour. I am your host, Carl Sussman. Thank you so much for being here today. We have our special guest, RJ Lehman, and he is here. We are talking about the California insurance crisis. Before the break, we were talking about Proposition 103 and the intervener process. We're going to keep going with that. RJ, I want to just get your 2 cents on this. People use the phrase California's insurance crisis so loosey-goosey now. Can you tell us what does it actually mean for the consumers when we're saying there is an insurance crisis? What is actually happening?
The biggest thing that you could see is the growth of the FAIR plan, right? So the FAIR plan is for people who cannot get coverage in the private market. It's a take all comers situation, but it is not on stable ground itself. And as it gets larger, I mean, it has historically been only about 1% of policies, and I think the last I saw was double digits. Certainly over 10% and maybe 15, even approaching 20, and that is not something you ever see outside of the coastal, where I live, Florida, Louisiana, states like that, North Carolina, sometimes Alabama or Mississippi, although right now I think theirs is more under control than Californians is. So if that continues, it's not sustainable. And it is because several of the carriers that claim, had said that they were pulling out have issued forbearance on that decision, so they're not pulling out yet. They may not be writing much new business, but they haven't been, massively dropping policies. But there had been for several years, and we're still living with the aftermath of that. Entire sections of the state, in Central Valley, in Northern California as well, and Riverside, San Bernardino, where companies were just not going to write at all.
Interesting. You mentioned all of those areas have current fires burning.
Yes. Yes. I mean, Paradise is, sort of ironically named now. That this is like the third time in a decade that it's burnt to the ground.
Let me ask you about State Farm, because they have, I believe, 27% of the property insurance market share in California.
Yeah.
And they have stopped writing new business. They've non-renewed a fair amount of people. Yeah. And they are asking for a significant rate increase with the specific, under the auspice of, we need this to stay solvent.
Yeah.
My understanding is that Consumer Watchdog has published a 200-some-odd page rebuke of that.
Yeah.
And how does that work? If a company says, I don't have enough money to pay your claims, I need more money, and then a third party says, yeah, you do, and could potentially block them from getting that rate.
Yeah.
How does that work, and how is that helping consumers?
I don't think it is helping consumers. I think the threat is real, though. I mean, I do think that they would pull out altogether if they can't get what they need to be. And to be clear, I don't think they're saying they're insolvent nationwide. But I think there's
this is State Farm. I think general in California.
Right, their California book of business would be insolvent in that if they cannot get rate to remain, I mean, State Farm is a mutual, right? It's a policyholder owned organization. They make profits, but they are there to serve their policyholders. That's who they're owned by. If they can't, be solvent and pay their policyholders' claims, they can't continue to do business there. And I think that's a real threat. It's happened before. Again, Florida, we've seen all this, right? We've been through this, and the responses that Florida took in the 2000s when we went through this sort of crisis really they were short-term patches, and we're seeing the results of it now. That we incentivized a bunch of small companies to start up. They only did homeowners. They only did it in Florida. Once we had a nice stretch of no hurricanes, and once we started getting hurricanes again, all of them are either bust or they're out of the state. So that's what we want to avoid. Is you need a long-term solution. Prop 103, unfortunately, is very difficult to change because it's a public proposition. Only thing you can really do is either pass a new one, which is very expensive and unlikely to pass. Voters don't tend to want to vote for rate increases, or the legislature can do things within the bounds of Prop 103 that further its purpose. And then there's some things that the regulator can do. Those are mostly what we're seeing right now, is the regulator can issue new interpretations of old rules.
And as far as rate goes, it's been said, and people, you mentioned earlier, it's corporate greed.
Yeah.
How is it explained with companies that literally are either going bankrupt or leaving the state altogether? That's kind of like calling a bluff, I would say, right? I mean, if you're saying that you don't really need the money, you're just being greedy, and then you go bankrupt, or you don't need the money, and then you say, then I'm leaving.
Yeah.
What is the response to that in general? Because I can understand as a consumer not wanting to pay more for insurance, but I also understand how competition works, right? Yep. And when we have competition, prices go down. And when we're in a situation we are now where there is no competition, of course, prices go up even higher. So what is the answer to that?
Rhetorically, it doesn't seem to make much difference, right? To those who think the issue is corporate greed. I think there's always another fallback position, the greed was the executives, right? If they didn't take such high compensation, then maybe the company could have stayed in business. But the fact is, they're insurance is a profit-making business, and you can't continue to write coverage at rates that are unsustainable. So there's going to be some effort to make, as there has been in other states that have gone through this, put more of this on the taxpayer instead of the policyholder. I think that's a bad idea, because then you're just encouraging the riskiest behavior to continue, and having people who are at low risk subsidize people who are at high risk. long term, that's not a good idea. If you believe in climate change, which I do, and I think most people in the state of California do, you have
Is that still a thing? We have to call it a belief?
right.
Okay.
Then you have to adjust for the future. You have to, change your settlement patterns, change how you build your homes, especially if you're in a place that's at risk of wildfire. There's all sorts of mitigation strategies that you can employ to harden your home to all kinds of risks. Yeah.
Let's talk a little bit about that when we come back. I also want to talk about, in our final segment, what you think the outcome is going to be. What's the future outlook for the insurance marketplace? We could touch a little bit on the sustainable insurance strategy, which is the group of regulations that the California Department of Insurance is trying to work on right now. Let's talk about that when we come back. This is Insurance Hour. I am your host, Carl Sussman, and we will be right back.
Are you feeling lost in every time?
Hello. This is Insurance Hour. I am your host, Carl Sussman. Thank you so much for being here today. We are here on our final segment with our special guest, R.J. Lehman. He is the editor-in-chief at the International Center for Law and Economics. Brilliant guy, if I can say that, and not be blown smoke. I really mean it. He has his finger on the pulse of what's going on with the insurance market. And I want to, in our last segment, talk about what he thinks, because he's got the experience, unlike some random people that have such loud voices without any substance. I want to talk about what you think some options are for the long-term solutions for the insurance marketplace, specific to California at this point.
So, as I was just saying before we got off, clearly part of it has to be mitigation. Investing in wildfire is the biggest risk that we face here, but we haven't even gotten into things like earthquake, because in California that's a completely separate market, right? A completely separate product, which most people don't buy, and they're certainly at risk. So some of the answers are things people don't want to hear, like that property values have to come down. Like that's actually, you're going to have, if the insurance component of what you're spending, there's a cost to owning a property. If the insurance component goes up and interest rates have gone up, something else has to go down. There's just no question about it. And so it is likely that we're going to see declines, long-term secular declines in property values in places like California or Florida. That is obviously not what people who own homes want to hear, but it's just the realistic solution. You're also going to need, some more flexibility. As mentioned, I think Prop 103 is objectively very difficult to alter, but the regulators are doing the right thing and trying. It may not have a huge effect. It's not going to be a silver bullet, but at the margins, make the intervenor system more transparent, make it easier to file rates in a timely fashion. In California, we're talking 2 years in some cases to get a rate to market. Allow the rate making process itself to be more flexible in ways that I think are reasonable readings of the original statute. Reinsurance catastrophe models are the most obvious. There are some other changes that could be made. On the auto side, consider being able to use rates, or being able to use credit scores, or more likely pay as you drive, right? Which California is very stringent on how you can use it, but that's a product that's become very popular across the country in other states.
It's interesting, too, because part of Prop 103 dictates what auto insurance carriers are allowed to rate based on, and miles driven is a large part of that formula. So you would think that this would be a natural fit.
Yep, exactly. But it is. They have not wanted to allow the electronic pay-as-you-drive products that actually track the miles. It is just self-reporting is all that California would permit. But those are things that I think you can change. Longer term, we can hope for a better interest rate environment, make it more attractive to capital in general, as inflation eases a little bit and we get back to a more normal pace. But we may never get back to those zero rate days that we had for so long that made this easy, made reinsurance cheap. That's just probably gone for at least the rest of my lifetime. Maybe younger kids might see it again someday.
Right. No, I hear what you're saying, and I think that the fact is that people, in my opinion, and you tell me what you think, need to accept the fact that things are going to cost more money to insure. Insurance premiums are going to go up, and they have to because exposures have gone up. And on top of it, to your point, with the way interest rates have been going, everything that has to be purchased by insurance companies is costing more money.
Correct.
So how do you explain to the average person that everything is costing more, from hotels to movies to groceries, but they don't want the insurance premiums to go up? What is the logical explanation to that?
Well, they've had a regulator that allowed them to stop that, right? Where there's no regulator of movie prices, or lots of other things. At least, and there shouldn't be. I'm not saying there should be, but that has been the fact that insurance is one of the few industries, insurance and utilities basically are the industries where you still have to ask permission to change how much you charge, is just makes it easier for those people. Have complaints about rising prices everywhere, but insurance, they can do something about it. And
sometimes I think where we are now is we've done something and we've sort of shot ourselves in the foot over the long term, because like I said, when if I look back 5-6 years ago and we had 20, 30, 40 companies eagerly writing home insurance and auto insurance, and now we may have one.
Yeah.
And it might be a company that has tight restrictions, or it might be a company that's not admitted and not covered by the California Insurance Guarantee Association. So we've got to, I suppose I'm at the place now, and I'd love your take on it in our last couple of minutes here, that we're here because of the way we've been doing things. And if we don't like where we are, logically we have to do something else. Is that fair?
I think it's absolutely fair, and I think it's on the climate portion of this question. It's just leveling with people that if you think this threat is real, and I think this threat is real, we're going to have to do something to adjust to it. There's no other option. Yeah.
There's no question about it. And finally, if I can, I'm going to throw something at you you're not expecting. Adam Schiff tossed something out that we may hear about the federal reinsurance plan. And let me give you 30 seconds. What is RJ's thoughts on the federal reinsurance potential plan?
I've always thought the beach house bailout is a bad idea. And I say that as a Floridian who would benefit from it. But it is not a good idea for the country.
So insurance carriers need to stay insurance carriers, and the feds need to do whatever they're doing.
Correct. Yeah. I mean, the best you can say is people with low income, maybe you help them afford the cost of coverage, but you don't want to shift this all onto taxpayers.
I hear you.
Yep.
RJ, I cannot thank you enough for spending time with us today. It's been an amazing conversation and so much information. I would love to have you back. Hopefully, I can ping you again when there's some more changes. It seems to be every day, or practically there's something going on. I'd love to talk to you again once we find out what this ruling is coming down from the DOI. Yep. And I thank you so much again, everyone. Again, this is RJ, or Ray, depending on if it's business or personal, editor-in-chief of the International Center for Law and Economics, insurance expert, and has written some amazing articles. If you haven't read them, I'll put a link to them as well, and you can also search for him online to find them. RJ, thank you so much for being here today.
Thank you.
And with that, we will talk again. This is Insurance Hour, and I am your host, Carl Sussman. Take care.
I do want to thank all of you for taking the time to listen today. I know insurance is not necessarily the most sexy concept. It's not the most exciting thing in the world. It is important that you understand what it is you're getting, what you should be looking for, red flags, you name it. You just need to know more than you used to. Things are more complicated than they used to be. If you have any questions, please reach out to me directly. You can email your questions to questions@insurancehour.com or call and leave a voicemail at 559-656-0317. Educating and entertaining Californians, one insurance policy at a time. This is Insurance Hour. The show is dedicated to Shamrock Papa.